Hey folks, let's talk about some accounts receivable today. So what we're going to do is we're going to go over two methods of ways to account for the bad debts, because not everyone who has charged a product is going to pay for it, right? So we're going to talk a little bit, not much really, about the direct method. It writes off bad debts when they actually go bad. So the direct method is really not GAAP, but it's the only method that the IRS allows companies to use. So GAAP also says that if it's not materially different than the allowance method, you can use the direct method. So you probably need to know some information about that. This video is really not about the direct method. It's more about the allowance method. And it is an estimate of the bad debt expense for each year. And there are several different ways to work it. And that's kind of where we're going to focus today. So the information that I'm going to use in each example is the sales is going to be $500, and that has a normal credit balance. Accounts receivable has a normal debit balance, and it's going to be $200,000 for right now. The allowance for bad debts is also the same account as allowance for doubtful accounts. I learned it as bad debts. That's what I still call it. So when I refer to bad debts, it's the same thing as doubtful accounts. And for these examples, we're going to pretend that it has a $2,000 credit balance. You can also work it because it could end up having a debit balance before you start making any adjustments. Speaking of adjustments, these are all adjusting entries at year end. So what we want to do is we want to reflect on the balance sheet the accounts receivable at its cost, and then we want to subtract our estimate of what we think is going to go bad, that's not going to get collected. And so to do that, we'll subtract on the face of the balance sheet the allowance for bad debts and come up with the net realizable value for accounts receivable. Okay, two methods to calculate it, direct and allowance. We're going to work on the allowance method, and there are two different main approaches. You can work it with income statement or the balance sheet approach. So if I do the allowance method and the income statement approach, here's the assumption or the information that a problem would give you. The company determines that 5% of sales. What financial statement is sales on? You got it, income statement. So when we're using the income statement approach, we usually take a percentage of an income statement number. So 5% of sales is a good estimate of what the bad debt expense will be for the current year. So we're going to take a percentage of the income statement number, 5% of sales. Sales from above was $500,000. At 5% is $25,000. That number that we just computed is the journal entry amount. So you don't have anything else to do for this. At the end of the year, you're going to debit bad debt expense, credit allowance for bad debts for the number you computed, $25,000, and you're done. Piece of cake. So on your balance sheet, you're going to show the accounts receivable at cost of $200,000 minus the allowance, which now has $27,000 in it, and the difference is your net realizable value. Okay, the second approach is the balance sheet approach. And I'm going to do, I believe it's 3 examples for the balance sheet approach. So first example, the company determines 12% of the gross, which means total, accounts receivable balance is a good estimate of how much of the receivables we're not going to collect. So the rule, number 1, we're going to take a percentage of a balance sheet account. So accounts receivable goes on the balance sheet. I'm going to take 12% of my gross accounts receivable, which was $200,000 from above, times 12% is $24,000. Okay, pay attention. The number that we just computed is the required credit balance in the allowance account. So we're going to have to take into account the previous balance in the allowance account. So it's a good idea to go ahead and draw up a T account for the allowance for bad debts. Plug in what your previous balance is, whether it's a credit or a debit. Plug in what you expect or what you just calculated the required credit balance to be, and then you solve for what you want in the journal entry. So in this case, we're simply going to take the ending balance that we need and subtract the beginning balance and get $22,000, and that's the dollar amount for our journal entry, which is an adjusting entry at the end of the year. We debit bad debt expense, credit the allowance, $22,000. So now the net realizable value is going to be the cost of accounts receivable at $200,000 minus the allowance, which is $24,000, and the difference is the net realizable value. And that's example 1. Okay, example 2 is going to be very similar. Here, the company is going to determine that 14% of net accounts receivable is a good estimate. So we're going to take a percent of a balance sheet number, net accounts receivable that we started with, way up here at the top, is accounts receivable at cost minus a credit balance that's in the allowance account. So 200 minus 2 gives us 198. Right there. So we're going to take 14% of 198, the net accounts receivable, and that will give us 27,720. Anytime we're dealing with the balance sheet approach, the number we compute is the required credit balance. So draw a T account, plug in what we started with, which in this case was a $2,000 credit balance. Plug in the required ending credit balance of $27,720 that we computed. The difference again is the journal entry amount. So in this case it's going to be $25,720. So when you put this on the balance sheet at the end of the year, you're going to have accounts receivable at cost of $200,000 minus your allowance account with a balance of $27,720, and again the difference is your net realizable value. Okay, we're doing the same thing every time. It all works the same. If you ended up with a debit balance to start with instead of the credit, then you simply add the debit to what you want to end up with, and that's the amount of your journal entry. So you can do the math in the T account and it comes out to this $27,720 balance at the end. Okay, the third example for the balance sheet is a little bit different. Okay, we're still working with balance sheet accounts, and what a lot of companies do is they will do what's called an aging analysis of the total accounts receivable. So what they've done is they've analyzed all the accounts and they've placed them into categories according to when the account was created. So usually they do it in the form of ages. So we have current accounts receivable that are not due yet, and I just made up numbers, 100,000. We have accounts receivable that are 31 to 60 days old, so between 1 and 2 months old. I made up the 50,000 again. Then we have up to 3 months old, and we have over 3 months old. And notice that the total equals the total accounts receivable at cost. So somebody has done some research, and after researching all the bad debt percentages, they have determined that the older the account is, the less likely it is to collect it. And if you think about it, it kind of makes sense. The newer the account, the more likely it is you're going to collect more of it. So the research came up with the percentages. I'll give you the percentages. You don't need to worry about it. So all we're going to do is we're going to multiply the accounts receivable in a particular category by the percentage for that category to come up with how much we think in that category is not going to be collected. So 100,000 times 5% is 5,000. 50,000 times 10% is 5,000. 30,000 times 15% is 4,500. And 20,000 times 25% is 5,000. So the total that we think that we're not going to collect is 19,500 from that whole 200,000. So the rules, we took a percentage of a balance sheet number, okay, accounts receivable. Based on the aging analysis, we come up with the 19,500, which again, because it's the balance sheet method, is the required credit balance in the allowance account. So I'm going to draw a T account one more time. I'm going to put in 2,000 for the previous balance for my allowance account. I'm going to plug in the 19,500 is what I want to end up with, and I'm going to compute the formula for what my journal entry amount should be. So it's the amount it takes to go from 2,000 to 19,500. So I want to put a 17,500 credit in my allowance account, and we're going to offset it with a debit to bad debt expense as of the last day of the year because it's an adjusting journal entry. One last time, on the balance sheet, we're going to show accounts receivable at cost, the 200,000, minus the 19,500 in the allowance for bad debt account, and that's going to give us the net realizable value, how much we think we're going to collect of our accounts receivables. Okay, that takes care of accounts receivables. I hope this video was helpful, and I'll see you next time.